Hey, if you're a new options trader, specifically an options buyer, even a veteran options trader, if you're finding yourself having trouble being profitable consistently in the options market, I can guarantee that there's three areas that are holding you back that you need to concentrate on. So in this video, I'm going to show you the three secrets, the three key elements that will definitely turn your options trading around. So if you want to watch this video and find out what these three key elements are, then stick around. And let's go. All right, everyone, Lee Lowell here from smartoptionseller.com. So what you see in front of you are the three secrets to successful options trading. These three key elements are definitely going to help you if you're finding or having trouble being profitable consistently. Okay, and we're going to talk about from the option buyer's perspective, and that's whether you're buying put options or buying call options or buying call spreads or buying put spreads, whatever. Very directional trading we're going to be talking about today. So if you want to see or understand, three key elements that may be holding you back, let's discuss. Okay, the number one, the biggest key to being successful when you're trading options as an option buyer is that you have to understand which way the stock or ETF, whatever you're trading, is going to be headed to, okay? There's a reason why options are called derivative contracts, because their values, these option values, are derived from other sources. And the most important of those other sources is the stock price and where the stock goes in the time allotted, which is the expiration date. Most option buyers cannot figure out how to get the direction right and the timing right consistently all in the same trade. Because when you're buying options, whether you're buying call options or buying put options, that's exactly what you're doing. You're basically making a guess as to where the stock is going to finish on the expiration date, if you hold that option to expiration. So the number one most critical factor is you have to figure out or have to have an idea which way the stock is going to move. And the best way to understand that or to figure that out is by looking at stock charts, which is called technical analysis. If you're just out there an investor saying, you know what, I just want to buy some call options or I just want to buy some put options, and you don't even look at a stock chart, how are you supposed to know which way the stock is trending? The biggest thing about a stock is which way it's trending. Is it trending up? Is it trending down? If you're just buying options and you're not even looking at a stock chart, then you're doing it all wrong, man. I'm going to tell you right now, if you don't know how to figure out what a stock chart looks like, then you have absolutely no reason to be trading options. I'm giving it to you straight, okay? So the best way to figure out which way a stock is going, which way it's trending, which way it may be going, is to look at a stock chart. So let's just figure that out. So what you see in your screen here is the number one secret right here. Let's get rid of this thing from Norton. What is the trend of the stock? Where are the support and resistance areas? What patterns are developing? So let's just jump right into our stock charts here. And this is what I look at. And this is how I figure out what's going on with the stocks. So in this particular case, let's just say we're bullish and we want to buy call options on a stock because that's a bullish type of strategy. So you figure, all right, I just want to buy some call options. Well, you got to figure out what stock are you going to trade these call options on. And then your first item is to look at a stock chart, and you want to see which way a stock is trending. Okay, so what you see on your screen here is a daily bar chart of Pepsi. Here's the symbol up here, PEP. Now, you can see this is about a 2-year look back frame, time frame for Pepsi. You can see over these past 2 years, Pepsi has been trending upwards. Okay, we draw these blue trend lines just to give us an idea of which way the stock is trending, and you can see how it bounces up and down in the trend lines, within the trend lines. So it's most likely that Pepsi is going to keep going in that upwards trend over time because there's nothing that's caused it to fall out of this uptrend here. Okay. Now let's look at another stock like, let me move myself over here a little bit. Let's look at a stock like Verizon, okay? I like Verizon as a company. I want to buy some shares of Verizon, but the stock charts are telling me, no way, man. It's not time to buy shares of Verizon. Why? Because look at Verizon has been trending down over the last 2 years. Why would you want to buy a stock or buy call options, both bullish strategies, when the stock is trending lower? So if you're thinking, even before you look at a stock chart, you're thinking, you know what? I like Verizon. I like it as a company. I want to buy some shares of Verizon. I'm just going to buy some call options because someone told me to buy call options. Well, if you're smart, you look at a chart of Verizon and you'll say, wow, Verizon looks pretty bad. It's just been going down, down, down for the last 2 years. And even right here, here's a 200-day moving average. I got a 20-day moving average, a 50-day moving average. They're all sloping downwards. The price action is going down. Why would I even think that Verizon is ready to go up? Just because you're bullish, you want to buy Verizon, doesn't mean that the stock is ready to go up at that time. So your first order of business is you got to figure out or look at the charts to see which way a stock is trending. Now, if you were bullish on Pepsi, then this would be a much better stock to get potentially long on, whether you're buying shares or buying call options or buying call debit spreads, whatever, because Pepsi is trending up. Now, if you want to use a little bit more of a timing method, you can wait for Pepsi to fall back to maybe the bottom edge of the downtrend, the uptrending channel here, or maybe see if it can connect with the 50-day moving average here. So you can use your timing to, get your entry a little bit better here. But in the long run, Pepsi has been trending up. So you're getting in on a stock that's going in your direction, okay? You want to find a catalyst to get into these option trades. If you want to find a bullish catalyst or have a reason to be bullish, make sure the stock is trending upwards. The other things you can do is look for support and resistance levels. Same thing here. The support levels are along the bottom edge of the trend line, and the resistance levels are at the top edge of the trend line. So if you're thinking you might want to buy call options on Pepsi, well, then maybe you see if Pepsi currently comes down to either the 50-day moving average or the bottom edge of the trend line. That would be the support area, okay? You can also use the RSI, which is what I use. This is a 14-day RSI. You can wait to see if Pepsi gets a little bit oversold, and if it connects with the bottom edge of the channel, that could be a good area to potentially get in long because you're thinking that the stock's going to turn around and move back up. Now, Verizon, buying call options on Verizon would not be a good thing here because the stock is trending down. So you want to look at, for the number one, the trend, and you want to look for support and resistance levels, and you want to look for patterns. Now, patterns are these things where we've got some triangles here. Okay, this is what's called an ascending triangle pattern, typically a bullish pattern. Doesn't work all the time. We have congestion patterns, we have W patterns, M patterns, all these different patterns that you can use. These are simple technical analysis patterns that you can find over and over again. I want to give you some resources here to help you up your technical analysis game, which is chart reading. So I have 2 books here, okay? Now these 2 books, it's Charting Made Easy and 7 Chart Patterns That Consistently Make Money, okay? And you can see the authors here. Now, I'm going to list both of these books down in the description. Read the description of this video below, and I'll have the links for those 2 books. But let's also take a look at some websites here, some free websites here. This is our Puts on Basics ebook. I'm going to show you that in a little bit. So here's a website, chartpatterns.com, okay? Free, simple. These are certain patterns that repeat over and over again. You can click on the pattern here and it'll give you a little synopsis of what the pattern is. These are just basic chart patterns that people follow all the time. Another website you can go to is stockcharts.com, okay? And you click on the chart school, okay? This will give you free, you can go through these chapters here and learn all about technical analysis. So your number one goal here to being successful with options trading is you got to figure out how to read the stock charts, how to figure out where the stock is trending, and how to figure out if it's going to continue in that direction. There's no reason to take a directional trade, whether you're buying call options or buying put options, without knowing which way the stock is trending. Okay, so that's the number one secret to figuring out how to be successful with options trading. Number two, pick the proper strike price. Most people that I've talked to, most students that I have, when they buy call options or they buy put options, they're choosing the cheapest options on the board. Each expiration month has a list of options that you can choose from, and they're all different prices that will cost you different amounts of money. A lot of the people that I talk to, if you're bullish, they'll buy, the cheapest call option on the board for the shortest expiration date because they don't want to spend the money. All right, so let's look at our option chain here just for some examples. And let's look at, let's pull up, what's a good stock? Let's look at Apple here for a second, okay? So this is Apple options, and this is the Interactive Brokers option chain. Interactive Brokers is the broker that I use. So if you want information on a broker to use, down in the description is a link for Interactive Brokers, and you can learn some more about them if you don't have a broker yet or if you're looking to switch brokers. Okay, so here's the option chain for Apple. We got call options on the left, put options on the right here, and all we need to do is concentrate on the bid-ask comms. So let's go to the options that expire next Friday, July 21st, 2023, 9 days left. And if someone's bullish on Apple, here's the last price for Apple, right around $190 a share. Someone's bullish on Apple, but they don't want to buy the shares. They want to buy call options because you can leverage your money. But what most students of mine will do, or people that I've talked to, they'll scroll through the option chain here, and they'll look at really, really cheap options that expire in a short period of time. So these 9-day options, they look at let's look at the 210 calls right here, are worth 2 cents a contract. So if you buy one call option, it'll cost you $2. So people will say, I'm going to, this is my lottery ticket. I'm going to buy call option and cost me $2. But with Apple at $190, the Apple has to go up all the way up to $210. It's a $20 move in the next 9 days. Okay, can Apple do that? Can Apple go up $20 in the next 9 days? Well, I'm going to show you the probability calculator, but also that's a very speculative type of trade because you're saying, I think I know that Apple's going to go up $20 in the next 9 days. How do you know Apple's going to go up $20 in the next 9 days? It's better to use your money more efficiently, which is to pick a different strike price that has more of an opportunity to get to the break-even point. Okay, so at a minimum, you should be looking at the money strike prices. That 210 calls what's called out of the money. That strike price is listed way above the current price of the stock. It was $210 strike, $20 above the current price of Apple. And at the money strike is the strike price that's closest to the current price of the stock, which would be 190. So if you look at the cost of the 190 calls, you could probably buy those things for $2.05 a contract, which is $205. You buy one contract, it costs you $205. And the break even would be, here's how you figure out the break even. You take the strike price 190 and add it to the cost of the call option. So 190 plus $2.05, $192.05 is your break even. As long as Apple gets above $192.05, you'll be making money on that call option contract. That means Apple only has to go up $2 in the next 9 days. That's a pretty easy, it's an easier thing for Apple to do in the next 9 days, to go up $2.05 versus $20. Okay, so you're giving yourself more of an opportunity to make money when Apple stock moves. Okay, so we also look at the delta. At the money options have roughly a 50% delta. Deltas range from 0 to 100%. At the money options have about a 50% delta. The delta tells you how sensitive the option price is to movements in the stock. So if Apple moves up $1, your call option contract will gain about 50 cents per contract, or $50. All right, so you want to purchase strike prices that get some movement when the stock moves. Now, if you look at these 210 calls, it has a 5 delta, which means if Apple stock jumps $1, these 210 calls will only go up maybe 5 cents. You'll make $5. Okay, so you're not getting a lot of bang for your buck. Now, come expiration day, let's just say Apple jumps all the way up to $209 by expiration day, and you bought these 210 calls. Well, you're gonna end up losing on that trade because Apple had to get above 210 in order for you to make money. Now, if you bought the 190 calls and Apple goes up to $209, that's a $19 move, and half of that's roughly, $9.50. So these things will be worth about $11 at that time. You'll make $1,100. Okay, right? 190 to 209. I'm sorry, that's $19. $19, excuse me. You'll make about $17, $1,700 on this one call option. Apple goes up $19, you'll make about $17 on these, and you'll lose your investment on the 210 calls. So you want to pick a strike price where you're going to get some movement out of it. Okay, so that's your lesson. Your secret number 2 is to pick a different strike price than those cheapy, out of the money strike prices. At a minimum, you want to choose the at the money strike prices. Let's go back to our list here. And the third on the list is give yourself more time, meaning pick a further out expiration date. Most people think that they know where the stock's going to go in the time allotted that they choose. Majority of the time, you're going to be wrong because the stock's just not going to move as far as you thought it would in that short amount of time. Like I said, most people opt for these short-term options because shorter-term options cost less on a dollar basis. They don't want to. Longer-term options cost more. People don't want to pay more for them. But I'm telling you, you got to give yourself more time to be right. If you go back to the charts and you say, I want to buy Verizon because I like Verizon and I'm bullish on Verizon, but Verizon keeps going down. And if you buy a week option, 2-week options, Verizon's not going to go anywhere. If you buy yourself a 3-month option, let's say, now you're giving Verizon 3 months to potentially make the move higher. All right. So let's go back to the list here. Give yourself more time. Using 1-week options are what I call make or break. The stock has to move in the right direction in that 1 week's time, or else you're going to lose your investment. Do you really know where the stock's going in 1 week's time? Do they have earnings coming out in 1 week's time? You got to understand that anything could happen in a week. But over a longer term time frame, 3 months, 6 months, the stock will generally move in the way that its earnings and the underlying fundamentals of the company are telling it to move. So do yourself a favor, give yourself more time. Obviously, the more time that you pick, the option will cost more money. Yes, that's true. But you're giving yourself a chance. If you know that the stock's trending up and you're catching it on a dip, give it some time to continue on in that upwards momentum. If you're buying call options, give yourself that time for the stock to keep going higher, and that option contract will pay off. It's the same thing with buying put options. Now, if we go back and look at Pepsi, and you're like, Pepsi, I think Pepsi's topped out here and it's going to go down. Well, number one, you're going against the trend. Number two, if you think that's true, then give yourself more time. Maybe some bad news will come out for Pepsi in the next few weeks or months. Give yourself some time for Pepsi to keep going down. Otherwise, you're just going against the grain if you're buying these short-term put options. All right, so there you go. There's your 3 secrets to more successful option buying, okay? You got to understand where the stock's going. You got to pick the proper strike price to give yourself more bang for your buck. And you got to give yourself more time than you think you need. All right. Now, I told you we were going to look at a probability calculator. We can go to our website, smartoptionseller.com, and we're going to look at the calculator. Let's find the calculator. And we're going to pull that up, and I'm going to type in the password. All right. So let's just take a quick look. We're going to figure this out. Let's look at this Apple trade for a second. So let's just say Apple's at $190, and we've got 9 days ahead, and Apple's probably about a 25% volatility. You can find those numbers on the internet. And you're going for the cheapy 210 call. What are the chances of Apple going from $190 to $210 in the next 9 days based on its volatility of 25%? And we click on go. And what you're going to see is there's a 99.46% chance that Apple's going to finish below 210, meaning you're going to lose 99.46% of the time. Apple has less than, over here, finishing above the highest target, meaning finishing above 210 is a 0.5%. Okay, you're picking the wrong strike price. So the probability calculator is a great thing to help you figure out what are the chances of a stock moving from point A to point B in the time allotted. Now, if we move it to the 190 strike, now our break even was 192.05. So let's just see what the chances are of Apple getting to 192.05 in the time allotted in 9 days. You'll have a much better chance. Okay, now you have almost a 40% chance that Apple's going to move the $2 that you need it to move. That's fantastic. Okay, you're never going to get more than a 50% chance. When you buy a stock, your odds are 50-50, right? If you buy Apple right at 190, there's only a 50% chance it's going to go higher or lower on the next tick of the stock. So your stock picking is never going to be more than 50%. Your options trading will never be more than 50% either. But here you got a 40% chance. So that's how you figure out, what are the chances of a stock going from point A to point B. That helps you understand why picking that strike price is really important. Okay. Now, if you want to see where we get this probability calculated from, you can go to our services and you can take a look at purchasing the calculator if you want. This is for members only that subscribe to our newsletters, but you can also pay for it on a monthly basis if this is something that you want to have. All right. So the other thing is I showed you those 2 books. In the description down below, I've got other details on other things, other websites that help me. You can also go to our helpful links tab on our website, smartoptionseller.com. You can go through all these links here. These are brokers and books and other websites that I use personally that help me in my own trading. Okay. And lastly, our services at smartoptionseller.com. Hover your mouse over here. We have our 2 newsletters. We have our coaching sessions if you need some help getting to that next level. Lastly, we're all about option selling here. We talked about option buying today, but we like option selling better because it gives us much higher probabilities of profit. So if you want to learn a little bit more about option selling, specifically put option selling, on our website here, click on the Put Selling Basics link. You could read a little bit about this ebook that I wrote. Scroll through it. You can read some of the testimonials. Put in your name and email address here. We'll send you an email with a link to download the book. Okay, this box you'll find on all over our website. You only have to fill it out once, so don't worry about filling out multiple boxes. It'll only work once per email address. Okay, so that's it for me. Once again, your 3 secrets to successful options trading right here. You got to use these things or else you're going to be in a world of hurt, and you're going to just leave the options trading game in disgust, and you'll be stressed out, and you're going to say, I just lost all my money trading options. Try these 3 strategies. All right, that's all for me today. Hope this video has been helpful. Give me a thumbs up. Leave me a comment. Send me an email. Hit that like button. Don't forget to subscribe. Hit that red subscribe button in the bottom right-hand corner. It helps the YouTube algorithm show this video to more people. All right, this is the end here. I hope it's been helpful. And this is Lee Lowell signing off.